Not Titles podcast is proud to be sponsored by Land Trust Title Services, your partners for results. Well, hello, this is Steve Kaempf with the People Not Titles podcast, and I'm really pleased today to have my friend Ryan Bakke here. Ryan is a real estate investor. He's a real estate coach, coaching investors. He's a serial entrepreneur, and he's a person that really is expert at showing people how to minimize, reduce taxes who are investing in the real estate space. So Ryan, thanks a lot for being with us today.
Hey, it's awesome to be here, guys.
Yeah. So Ryan, let's get right into it. You graduated from college. You are a licensed CPA, but you took a little bit of a different path. How did that come about?
Yeah, I mean, it really all started when I was working at my first job just out of college. I was working at a CPA firm, and I was doing 2 tax returns that day. So I had a tax return for a married couple making $200,000 a year, and they were both W-2s. And then I was also doing a tax return by a guy who owned a couple dozen apartment buildings in Chicago. And so he was single, and he was making $400,000 in cash flow from these apartments. He had a lot of apartment buildings in Chicago, but he paid less in taxes than the married couple who only made $200,000. So not only did he make double the money, but he was also single, which means he was in a higher tax bracket than a married folk. And I asked my boss, I say, how is this possible? My boss at the time, and he goes, it's because he invested in real estate. And that was a sentence that really changed my life, because ever since that moment, I've been trying to learn and figure out how it can be that these people can make a boatload of money and not pay anything in taxes. And I've really devoted the rest of my life's work to understanding that and helping other people understand it too.
So up until that point, you did not own any real estate.
That's right. Yeah.
Okay, so from that moment where the aha moment, the light bulb went on, when did you buy your first piece of real estate?
So the light bulb moment for me happened, I want to say I was 18 or 19 years old. I bought my first property when I was 21. So once I had that light bulb moment, that's when I said, okay, how can I get into real estate, right? And then you talk to family, you talk to friends or people. Nobody's owned a property before. Nobody's even owned a business before. Because the school system and society, unfortunately, it teaches us to be an employee, not an owner.
It teaches
us to be a tenant. It teaches us to be a tenant, not the landlord. It teaches us to be the borrower, not the lender. And so I spent that 2 years there educating myself on how can I get my first property. How can I get my first property when I'm under 25? Maybe work income or not, whatever. How can I get my first one? And that's where I learned about this concept called house hacking, where you can get an FHA loan, you can put 3.5% down, and you can own up to 4 units of property, up to 4 units, right? And so I could put 3.5% down, I could live in 1 unit and rent out the rest. And so that's what I did. So I bought a duplex in Tinley Park. That's where I'm from, Tinley Park. And I lived in one side and I rented out the other. And at the time, I was getting $1,200 a month when my mortgage was $1,600. So 21 years old, I'm living with $400 a month is what I'm living on, and I'm making a good W-2 income because I got a good job at a CPA firm. But that was my path to building wealth, because I was cutting my largest expense, which was my housing. And I could go into how I was able to learn how to negotiate. So I learned about, hey, as-is offers versus with the inspection contingency and all these different things, getting seller credits. I learned that in that 2-year time frame. So not only did I learn about taxes, I learned about negotiating, what to look for in deals, and how to reduce my closing costs. I've learned how to negotiate seller credits and things. So that's kind of how I got started. And then now, fast forward 4 years later, I own 3 multifamily houses. I own 2 short-term rentals, and then I have 2 campground or RV projects. So give it within 5 years, I've able to done 7 or 8 deals.
Fantastic. That's amazing. What a story. Young entrepreneur. Okay, so so initially your investment was while you were working for somebody else, right? And so there's one thing to say, oh, I'm working a job and I'm going to go invest in some property, which people can do, and they can work with you on really strategizing and building that. But at what point did you say, okay, I'm going to move out, I'm done with my job? Would that revelation come at the same time? Or did you think to yourself, okay, how do you position yourself as an entrepreneur beyond just being an investor?
Yeah, I think a lot of times you'll hear this, I guess I've learned this phrase, but a lot of times little birds, they can't sing, so they chirp. But when it's a full grown bird, they start to sing their song. And for a while I was just a little bird chirping away until I finally had the platform to start seeing it, and that was through social media. So I started posting about tax content and strategies and personal finance and all these things, and then my social media following started to blow up. And that's when I started taking on clients on the side, unfortunately doing a little moonlighting.
Sure.
Sorry, my previous employer, but
hey, it's okay.
I started doing some moonlighting, and then I started gaining some traction, and I started speaking at these events, and I said there's a huge void for this knowledge and education. All these real estate agents, all these people don't know about these strategies. And I started making enough money that I was making more money on the side than my W-2 job. And I said, okay, what if I did this full time? And it was that year, that first year of kind of doing this on the side where I amassed those earnings. And then, okay, I'm going to do it full time. So I've been in this space doing full time, like I said, coaching, tax strategy, real estate investing. I've been full time for about 2 years now.
And did you think that you were going to be an entrepreneur when you got your job, or do you think, oh, I'm just going to build myself, I'm going to climb the corporate ladder?
I always had, hey, I want to, of course, make a lot of money, but I always did see myself climbing that corporate ladder, whether it was through a public accounting firm, kind of scaling up, and hopefully by the time I'm 40 or 45, I become a partner at a CPA firm, or maybe I'm a CFO or a CEO of a company. But it's just when you have a calling, and I think that's through my background and being a Christian, it's understanding like God gives you these talents and these blessings, and then you could use that what you're given to go bless other people, and in return you get financially and of course compensated very well through spiritual and things to do. And said now I can bless more people, and it's just really been okay. I have this money, let me pour more fuel on the fire of what I'm doing, and just being able to help a lot more people. Yeah,
I love it. Well, so Ryan, what impressed me about you is that you're a self-aware person. There's a lot of people that watch our podcast that are either going to become a realtor. They're wondering whether entrepreneurship is the angle that they want to take. They're thinking about becoming real estate investors and all that. When you took your first step to buy that first property, was this path clear to you, or was it more like you took the first step and then the next step and then the next step?
Yeah, I learned so much from the first deal that it wasn't really about the money that I made on the first deal, but the experience that I got with the first deal. Because that first deal, I could never, if I could turn around and say, hey, here's a $10,000 check, and I could have that experience of what I got from that first deal, I would pay it on a heartbeat, because that's what gets started. And I would say for any entrepreneur, the thing that strikes me the most is that there's going to be people all the steps away in life that'll say, what if it goes wrong? What if it doesn't work out? What if the toilet gets clogged at 3 a.m.? You hear that all the time from friends, family, especially I heard it a ton from my parents, a ton from my family. But there's nobody there that's going to tell you what if it could be better than you ever could imagine. And that's what it was for me, where I had no idea that there was this other...
Yeah, what if it goes great?
What if it goes amazing?
Yeah.
Right? And then I had this realization where it's like, okay, if you're an accountant, if you have a specific skill set before you try to get and become an entrepreneur, the worst case scenario is you just go back to doing what you were doing before. So
they'll always take you back.
Why not take the risk? And so my most actionable advice is figure out what it is that you want to do in entrepreneurship. Build 1 year's of an emergency fund. So total up your monthly expenses, times it by 12, and have 1 year of emergency fund. So that way, if maybe give it a year, and if money doesn't start coming in, worst case scenario, you just go back to what you're doing. But I try not to have a plan B. So.
Yeah, I love it. Were there times that you doubted? Were there times that you looked at it and said, man, did I make the wrong move?
There was definitely things in the process where, okay, I could have done that a little bit differently, whether it was the people that I decided to work with, or the employees that I hired and subsequently fired, or the relationships that I built. I definitely look back and said, okay, I could have done that a certain way. But I wouldn't say I necessarily regret anything. A lot of it's, hey, what can I learn from this? And so I'm constantly, if I have a relationship with somebody and it gets to let's say the closing table, or I go to close a sale or something like that, I always try to wonder, okay, I didn't close that, but what could I have done differently? And then you eventually stack all those learning experiences on top of each other, and that becomes the person you are today. So I wouldn't say I regret anything, but it's, hey, what can I learn from these mistakes and experiences? So at least running a business, one thing I try to do is hire somebody that can kind of do a little bit of everything in the business, which was a mistake. Unfortunately, there's a reason why there's people are employees, right? They're going to do one specific thing, and I made the mistake of trying to hire somebody that could wear multiple hats when really he just wanted to focus on one thing. So that's just like a mistake that I've made.
Yeah, and those are all learning experience. But if you no mistake is fatal, and they're all things you can learn from and leverage to get better, right?
And that's a good point. I always tell people if they're just getting started, to start small. Because if you let's say you make a 10% mistake on a $300,000 property, it's not going to set you back a ton. If you make a 10% mistake on $1 million multifamily deal, that could bankrupt you. That could really put a hole in your financial situation. So always start small, get those knowledge, get those wins. Like for me, it was buying a deal. I spent $240,000 on my first house. I didn't even have to come out of pocket for money, again, because I negotiated selling costs and whatnot. But that money, that $10-12 grand that I would have had to come out of pocket for, I'm going to start small. I'm not going to go big.
And then from there, okay, so you build your social media presence because you're talking about tax strategies and you're offering people advice and kind of sharing your journey, really, right? And what's worked for you. And okay, so now it went from people, liking you and being interested to saying, "Hey, Ryan, I'd like you to show me how to do it for myself." So talk a little bit about the people that have gotten involved with you. What's the success they've experienced, and what are the benefits that people have had working with you? A little bit of a profile of some of these.
Yeah, so I like to use the example of you're driving on a highway, right, and you have a destination. Typically, the destination is going to be financial freedom for most people. Hey, I'm working at a job I don't like. I want to spend more time with my kids. I want to cut back so that I can have that freedom. Some people like their W-2 job and say, hey, I just want to have a good nest egg sitting on the side. Well, whatever it is, it requires cash or cash flow. And the two things that are stopping you on that destination is going to be having to stop for bathrooms and tolls. And tolls are the IRS. Tolls are going to be the government. And typically, the profile of a client that we're working with is going to be an above average earner who's paying a ton in taxes. So I would say for a single person, you're probably $150,000 or more in income. For a married couple, it's probably $250,000 or more in income to kind of start working with us. But it's more so about saying, let's outline that destination. What are those goals? Do you want to have one property, 3 properties? How many properties? What are the purchase price? How are you going to buy them? Let's map out those goals, and then let's figure out how we can work in the tax strategy to help us benefit that. So a lot of times, I'll give you an example. We have 2 high earning W-2s. Maybe they're making $350,000, $400,000 total, and they're buying a short-term rental or they're buying a property. Well, on average, our client in 2021 was saving about $30,000 a year in taxes by buying real estate and learning how they could use the real estate losses. They're going to be paper losses, not cash losses, as we know. Use those losses to help offset their W-2 or their 1099 income. And so now that they're saving $30,000, that's going to be able to get us closer to that freedom destination that we want, because they can take that $30,000 and use it to go buy more deals and more cash flow, and then ultimately save more money in taxes.
So you are not, so there's quite a few people talking about real estate investment, but you're talking about it from a standpoint of really the tax benefits and how to leverage those so that you can really benefit.
Yeah, and that's a great point too, because I will be the first person to always say that you don't want to let the tax tail wag the dog. So you don't want to buy a deal just for the tax benefits. You get a lot of guys closer to the end of the year, they're like, oh, I just need to buy something. I just need to get something in so I can get the tax benefits from. Or they're people that are trying to execute 1031s and they just buy really crappy deals because they don't want to pay the tax. Never let the tax tail wag the dog. So I always try to present people. I have proformas and spreadsheets on my website and some of the tools that I share with clients. But it's, hey, let's look at this deal. Okay, it meets our investment goals, whether it's cash on cash or overall cash flow, and then let's see what the tax benefits do for it. Because if you only hunt for the tax benefits, what you're going to have is you're going to have a portfolio of low performing properties, which means it's going to be harder for you to generate more cash flow, to exit from those properties if you had to, and just overall, I'm spending a ton of time on these properties and they're not really servicing me right now. So I always tell people, don't let the tax tail wag the dog. You want to make sure that the deal works from a financial, take the tax benefits out, but then let's see what it actually does with the tax benefits inside. And oftentimes we've seen, let's say a 17% cash on cash deal turned into a 45% cash on cash deal, or doubling the first year cash flow because of those $30,000, $40,000 in tax savings.
Yeah. So it seems to me like, there's a lot of people that get emotionally involved in real estate, but it seems to me, just from my experience with you, that's not as big a part for you. You're really pragmatic and kind of take the emotion out of it and kind of numbers based.
And that's what a good advisor should do for you. A good advisor should say, I'm a third party, I'm an independent third party, I don't really have I don't have a dog in the fight, right? Mm-hmm. And I'm able to sit and look at somebody's portfolio and their goals and say, I don't think this fits your needs, or I should do something different. I had a client actually come 2 weeks ago and say, hey, I have this property in Alabama, it's a short-term rental at Gulf Shores, Alabama. I'm spending a lot of time managing it, I kind of want to get rid of it, doesn't really fit my goals. And I sit down and look at it, and she has, what I like to do is, I call it the cash on equity audit. So I look at the amount of equity that you have versus the expected net income for that year, and I divide those two together. So she had $150,000 of equity in a property that was making net $50,000 a year. And so I was saying, why would you sell this? This is a cash cow. Your cash on equity return is 33%. You're not going to get 33% returns anywhere else. And she goes, oh yeah, you're right. When you sit down and look at the numbers and you take the emotion and the logic out of it, it is a good deal. So that's the first thing, is there is going to be emotion and sentimental value to some deals, but you have to count it in. So if somebody says, hey, I got this property, there's a lot of equity in it, I kind of want to sell it, but my mother-in-law lives there or nearby. I want that to be a house where if we have to go take care of her, we can live there. Okay, now you're adding emotion to the equation, so we can't look at the numbers only one for one.
Yeah.
And so I always tell people, if you're going to have let's call it lifestyle, I call that a lifestyle asset, where if you're going to buy a house where it's, okay, maybe we'll go vacation there or snowbird there, you have to discount it and look at it totally different than you would a pure investment decision.
And how often or what percentage of your clients come to you and haven't bought even one property? Is it the majority of them, or are you kind of working with a mix of investors that come to you and go, hey, listen, I really need someone to fluff and buff my portfolio?
Yeah, unfortunately with tax, it's very reactive, not proactive. So a lot of people are, hey, I did all this stuff the previous year or a couple months ago, and now I'm trying to figure out how to combat that. What I've noticed is that's how it was when I started in this. And through the education by me and a bunch of other people, now it's becoming this thing where it's a lot more proactive. So people are starting to, even before they buy their first property or before they buy their next property, start reaching out to tax advisors and tax people like myself to say, what does this do for my situation, which I really enjoy. But to answer the question, I would say probably only 25% of people haven't bought a property yet before they contact me. The other 75 have already been investing or have bought properties before.
Okay. And Ryan, I know you're on Facebook, you're on Twitter, you're everywhere. What do those groups look like? Let's talk about the Facebook group. Are people interacting? Are there a bunch of investors there? I mean, what's the benefit of being a part of that, just that kind of discussion or, that mastermind?
Yeah, especially in the Facebook group, it's people that are investing all over the country. So we have as we're filming this, we have 6,500 people in there. And so somebody might say, hey, I'm an investor, I live in California, but I got a property in the Smoky Mountains. And then they might also follow up by saying, can anybody recommend a cleaner or a handyman in the Smoky Mountains? And then so that's when XYZ person comments, oh yeah, my cleaner, her name or his name is this, you need to reach out to him. So there's a lot of referrals within the network that I built to really help people out, because people might be investing out of state. I tend to deal with a lot of people that are doing vacation homes and short-term rentals. So this is like a affiliate network within the Facebook group. But then I'm also constantly posting tax advice in there, some clips and some videos. I host, I try to do it every quarter, but I'll do a webinar where I'll do a bunch of teaching and presentation, and then I try to play the clips back into there. But it's a really good network. Some people just come in and ask questions. I try to respond if I can, if not. And what's actually gotten great is because the group runs itself now. Because somebody will post, and there's somebody in the group that's already learned from me, and they'll just post right back. Say, this is what
you're
Ryan
like, okay, that guy's got it.
So now the group is just kind of running itself. So
that's great.
I want to say 250 people joined just this week.
Wow, that's amazing, Ryan. Congratulations. So what are the levels that people can get involved with you? Get maybe more specific about that. Is there an hourly thing? Is it coaching over time? I mean, or is it a little bit different? Just talk to me and we'll work something out.
I take the model of I don't want to withhold education or knowledge from anybody.
Yeah, you provide a lot of free
So
content.
I give everything away for
a lot,
free.
Okay.
So I give, whether or not you're a beginner, intermediate, advanced investor, I have something for you to give away. Whether it's a calculation, spreadsheet, or a video, or training modules, I try to give everything away. And then for me, it's more, okay, now that you have all this knowledge and understanding, now we can ask better questions and more educated questions, not only more educated, but pertaining to your exact situation. And so that's when I kind of engage people, is when they're ready to have that conversation of, okay, I know everything I need to know, but I need to know how it applies to my situation, and I want to learn that from you. So that's typically where I try to meet people at. As far as how I work with people, I can either take people one-on-one, and it's not just tax strategy with a one-on-one anymore. So I do entity structure review from a tax perspective. So I look at their current entity structure and figure out if they should rework things from a tax perspective. I look at their prior year tax returns, kind of see what's going on there. I offer tax strategy in that package, but then I also do that equity analysis review. And that's crucial right now, as a lot of people are sitting on equity. There's stats that come out every day. Hey, here's how many homeowners have this % interest rate, this much equity, so they're not selling. I help people make those type of decisions. Oh, should I refinance, HELOC, 1031? Should I sell and buy something else? Should I do nothing? Help people make those decisions in that one-on-one. Now, I call it my Tax Strategy Academy, which you can come in, and it's weekly office hours. So once a week, I'll get on, teach something, or answer people's questions that have joined the group. So they get a 1-hour consultation with me to start, and then they can get enrolled in this weekly office hours so that they can ask questions once a week for an hour. That's probably the number one response I hear from people that say, oh, I can't really get a hold of my accountant. Like, they never reach out. It takes forever. That's what I've tried to diminish that by saying, here's 1 hour each week where we're going to get in contact with each other. So
Yeah, and you might, someone might not need you for 10 weeks, but all of a sudden the 11th week, I need an answer to something, I can hop on and talk to you.
Yeah, and that's what I've really tried to differentiate myself from that and try to step out of my day-to-day operations, so that way if a one-on-one client or somebody in that group is trying to get a hold of me, I'm responding within 24 hours.
That's great. What's the vision for you, Ryan? Something that struck me as you're talking is, you've purchased some properties, so you put your money where your mouth is, in the sense of these strategies are real enough that I'm engaged in them. However, your experience is not limited to that, because you're working with so many people, probably people that have a bigger real estate portfolio than you, but they're still coming to you. So you get the benefit of seeing what that looks like 10 years down the road or 20 years down the road or whatever.
Yeah.
And so I think that that's a neat thing, that when people are tapping into you, they're actually tapping into all the experiences that you've interacted with, through your big network.
What my other clients are doing, people in this area.
Yeah.
And it's also funny too, because I'll see a lot of guys that are using different types of debt structure, equity structure, mezzanine, and all these things, and I'll ask questions. Hey, I saw this pop up on your closing disclosure. What exactly is that? And I'll learn a lot too from my clients, but I may or may not have this document that has all my clients' properties and knowing which markets are making money and which ones are not.
All right. Okay. I like that. How do you think big? I mean, has it been something that you've always have you been that kind of person, or have you been did you wake up and go, wow, I really am in control of my own destiny here, and I really can reach for something that other people all around me my whole life haven't reached for? How does that been? Because that's a different way to think.
Yeah, I would say that I need to start thinking a lot bigger.
Okay.
I was kind of, I don't want to say narrow-minded, but I was very short vision when I started, and now I'm at the point where I do need to start thinking bigger and kind of legacy and what do I want to do 5 years, 10 years, 15 years from now.
Okay,
and
so that's still in development.
Yeah, so this next 5 or so months is really about, and this is something that I teach. It's a concept called the Genius Zone, and it's a book written by a guy named Gus Hendricks. But he talks about that there's a certain category of activities that you were put on the planet to do, and that's your genius zone. And typically, people only spend 10% of their total time in their genius zone, and 90% of their time doing other things that they don't need. Admin tasks, shopping for groceries, or doing these other tasks where they don't necessarily need to be the one doing that. And so once I read that book and kind of applied these principles, I found that I was probably spending only 15 or 20% of my time in my genius zone before 2022. Now in 2022, I feel I'm probably spending 50.
The People Not Titles podcast is proud to be sponsored by Land Trust Title Services, your partners for results.
I'm probably spending 50 to 60% of my time in my genius zone and 40% of the time everywhere else. And the next 5 months are trying to figure out how can I spend 90% of my time in my genius zone and 10% of the time. Because if you're in your genius zone, that's going to be the work that you get the most fulfillment out of. And if you're aligned enough, it's also going to be the work that you're going to get heavily compensated for too.
Yeah, it's your kind of your God-given brand, right?
Yes.
So that's great. I love that. So what has been the impact for you dedicating yourself, setting yourself out? So first off, what were some of the steps for you to get in the genius zone? Like make that list and go, I need to offload some of this crap over here? Or
Yeah.
how did that look like at the beginning of the year when you're initiating that?
Yeah, it really is. You pretty much, so once you go through the stages of what the 4 different tasks are, it's basically on a series of, okay, very mundane, easily outsourced to, okay, these are kind of a little bit more important here, so I kind of got to find the right people to do those. Well, you go through that task and you just spend maybe 2 weeks writing out every single thing that you do in a day and figure out, okay, here's all this stuff that's over here in the non-important categories. That's not the genius zone. And once you figure that out, you kind of learn, okay, that's not genius zone activity. That is genius zone. And really, I tell people, you want to find whatever it is in the world that you're top 10% at, top 15%. You should know that, hey, what do I love to do? What am I really good at? And go all in. Just go all in on it. And for me, that was truly just taking concepts that are really complex for a lot of people, which is the tax strategy, which is the investing part, and boiling it down to something that everyone can understand. And that's my genius zone there.
You know, Ryan, it makes me think, I'm a big proponent of everything that you just said there, and I even think about that after you spend like probably half a year in the genius zone, there's a bunch more stuff you need to offload because you're generating just more work, more activity, more everything, and you need to be really conscious of constantly sifting through what you're doing and making sure you're really possessive of that. But there are people that are older. You're a young guy, and some people have no idea what their genius zone is. They've just been working a job that they don't like or whatever it is. So is there anything that you'd recommend for someone that just hasn't thought about how they were created or what they were built for, and maybe even lost a little bit of the hope of that?
I want to say the older that you get, the more your genius zone. And the genius zone, just to be frank, it doesn't have to necessarily be skills or activities that make you money. Your genius zone can be spending time with your family.
Sure.
And so typically the older that you get, the more that genius zone shifts towards spending time with family. And so the only way you're going to spend time with family is if you get out of working. And the only way to get out of working is to really start, save up like a squirrel and invest your money or start a business.
Yeah, so what I hear you saying is creating space for you to think a little bit, creating some freedom for yourself that you can get into that. So I agree with that. That's great stuff on the genius zone. Let's talk about mentors. Was there anyone that was really key? Because it sounds to me like you were a little bit, I don't want to use the word black sheep, but you made a move that your family said, hey, what are you doing? Watch out, that kind of thing, right? So who inspires you, and who has anyone taken you under their wing to help you?
Yeah, I would say my first sort of mentor, although he wasn't mentoring me, but I just seen him on social media, was a guy named Brandon Hall. And Brandon Hall was a CPA who, at 25 or 26, he quit the W-2 to start his own firm called the Real Estate CPA. And I started watching and following his brand and his platform, and I saw, hey, here's this guy who used to be Big Four, which is exactly what I was doing, Big Four accounting. He scaled this real estate CPA firm on the side eventually till he was able to leave. And then he does this full time now. Fast forward 7 years, I want to say he's got probably $8 million in revenue, 60 employees, and he's fully scaled out of the operations and moving on. So he was kind of the first mentor because...
So he was the model for you.
he was the model. He really laid the roadmap out, even for free. He's posting on social media, he's got the podcast, he's engaging with these groups and going to these conferences. That's really the playbook of what I need to do. And so he was really a mentor to me, even though I haven't... I never paid him or I never got one-on-one advice. We're good friends now, but...
but as a benefit of him sharing his journey with, and all of a sudden you caught the vision.
Just seeing that it's possible.
Yeah.
And he's told me before, he goes, you're light years ahead of where I was at that time.
Wow.
You're going to blow it out of the water. And so he was kind of like the first mentor, even though he didn't take me under his wing. And then since then, I've learned a few different, from a few different other people, especially about the idea of building a brand. So for one of my mentors, his name's Bill Faith. And so he talks about these three concepts, these three skills to build a personal brand. And I want to share them today here too, but he's taught me how the first step is becoming the person of interest at whatever it is that you do. So if you're a realtor in the Schaumburg area, let's say, you want to let everybody know that that's exactly what you do. And so for me, that was, hey, I'm a tax strategist, I'm also an investor. And so you want to post social media content about that. And what happens is people will start to respond and say, hey, a question would get posted in their group and say, hey, I have this tax question, this financial question. And somebody would respond with, oh, you need to talk to this Ryan guy because the Ryan guy knows the question or the answer to that. So I would just start going in these groups and posting answers to people's questions, trying to help people out without ever expecting anything in return. So I would never say, oh yeah, call me or message me if you have any questions. It was just providing that value without expecting anything in return. And then it leads to number 2, which is called the law of reciprocity. So the law of reciprocity is basically giving value to somebody without ever expecting anything in return. So it's kind of like Olive Garden. Olive Garden, when they bring you the bill, they give you a mint. Well, they did a study that said a waitress that brought 1 mint got 10% tip. Waitress that came and brought 2 mints got 15% tip. But the waitress that got the most money was the waitress that came to the table, left the bill and a mint, went to the kitchen and came back and brought more mints to the table. Because what that did to them was say, she went out of her way to provide more value to us, so we're going to give her a bigger tip.
Psychological.
Give value without ever asking for anything in return, right? Law of reciprocity, number 2. And then lastly, he taught me what's called the transfer of authority. So the transfer of authority, you can think of it as like a referral, but it's a warm referral. It's me saying, hey, I don't really know much about title or how that things works, but you really go talk to Steve because he's the expert in what it is that he does, right? Or, hey, I don't really know much about tax strategy, but you really go talk to Ryan because he's the expert in that and he really knows. Or this is what I know, but you really need to go talk to this person. So those 3 principles, those 3 key things are what I learned from Bill and kind of really what I teach other people now. So
it's interesting what you said about, is it Brandon, did you say?
Brandon Hall.
Yeah, Brandon. Is that Brandon set out on his own journey to try to be his best and all that, and that inspired you. And he had no idea that there was this guy in Tinley Park waking up going, ooh, right? And I think that inspires me to be my best, because you never know who's watching, you never know who's being inspired. And what I also found out, and I don't know if this is true for you, that guys like Brandon love to help guys like you.
Yeah.
Right? When you're hungry and you're like, man, I dig your information. Can you help me out? They're like, yep, I can help you. I see the tiger, the eye on the tiger here. I want to take this guy and help him out. So, that there's, once you step out of the comfort zone into the discomfort zone, people engage with you, and now you're with a whole different group of people that think differently, that are going for different things, and you just become different.
Yeah, that's exactly how it happened too, and that's now I'm the person to be for other people.
There you go.
Now I'm the person to tell other people what if it could be better than you ever could imagine. So
wow, that's cool. So you're still thinking about vision. You're still thinking about all those different things. We're excited, Ryan, to be able to have you talk to our real estate population and to our investor population, which we're gonna be announcing in August, where you're gonna do a session that really is gonna lay out how you can reduce your taxes, how you can show as realtors how you can have something in your tool belt to make you more of a subject matter expert. in helping investors achieve their goal of accumulating wealth and reducing their tax liabilities and stuff like that, and then how they can work with you as well. But where can people find you now on social media? I mean, we'll have all that in the show notes, but what's the easiest way to get you right now?
Yeah, it'll be Learn Like a CPA on all platforms. So Learn Like a CPA. It's going to be on Instagram, Twitter, TikTok, and then if you're on Facebook, go to Tax Strategies for Real Estate Investors. We have 6,500 people in the Facebook group.
Awesome.
And I still respond to all my messages too, so it's not going to be somebody else that responds. I personally respond to all messages.
And Ryan, in terms of real estate deals, can people let's say people don't have time, they're too busy making money, and they want to get involved in real estate opportunities, is that something that they can look to you for?
Yeah, that's a perfect catalyst for a joint venture or a syndication, right? There's the thing about real estate, and what somebody taught me is, in real estate you need three things to get a deal done. You need capital, you need time, and you need experience. But the thing is you don't have to have all three. So a lot of people might have the capital, but they don't necessarily, like you said, they're working too much, they don't have the time, and they've never done a deal before, they don't have the experience, but they have the capital. So you only need one of those three things. Typically, you either need capital or you need time and experience, right? You're not going to have probably just time, but maybe.
Right.
So if you have the capital, okay, you need to partner with somebody who's got the time and experience. So I have teams and networks that have the time and experience, or if you have the time and experience, and I love what you're doing and I love your deal, I can raise money to help you facilitate the deal. So in real estate, you need three things: capital, time, and experience. But it doesn't have to be all three by you.
I love it. So people can get involved with you that way. If I have capital and I want to leverage your time and experience, or the time and experience of the group, that's how they can tap into it.
Yep.
And you've done a couple of, you mentioned that not only have you expanded your multi-unit investment portfolio to out of state and those kind of things, you've done a few of those syndicated campgrounds and RV things. And talk a little bit about that.
Yeah, so we like the campground and the RV space because they trade like normal businesses. So short-term rentals, which is what we're also into a little bit, the short-term rentals, Airbnb, single-family rental, those are going to trade based off the sales approach, meaning that they're only going to be valued based on what the market values them based on the sales approach. But if you have an RV park or a campground, it's based on net operating income. And you can you can get a cap rate and back into an appraisal value, or a new purchase price or refinance amount. So we like campgrounds and RV parks compared to short-term rentals or other asset classes, because you can really drive the NOI of these things more than you can short-term rentals and multifamily or long-term rentals. And campgrounds, a lot of times people worry about Airbnbs because of the regulations. Well, campgrounds and RV parks have been around for decades, so they're pretty much grandfathered in. So we like them because they generate more cash flow. It's easier to exit because you can back into it. You can get an appraisal and refinance and get your investors out. And they're a little bit more safer than regular short-term rental investments.
Fantastic.
Yeah.
So, people have heard, we'll kind of wrap it up here. People have heard about interest rates are rising, inventory's tight, blah, blah, blah. Is real estate dead?
No, I would say that it's definitely getting a lot harder for deals to pencil out, but you should never stop. You should never put down the pencil. Meaning, like, you want to keep underwriting deals, even if they keep scratching out, because there's going to be a time where the market is a little bit better for a buyer. And if you just have your pencil down the whole time, it's like you're showing up for the test, the final exam, without going through the whole class. You want to be ready so that way when you do, come up on capital or the market does seem right, that you're ready to go. You never really want to time the market, right? Even if you bought in, if you think of a 30, 40-year span, even if you bought in at a little bit higher than you should have, in 30, 40 years, you're still going to have all that wealth built. So absolutely. I would tell people to never put their pencil down. Another thing I would say, too, is if you buy a deal now at 7% interest rate and it cash flows for you, typically every 1% that the interest rate goes up or down, it decreases or increases the purchase price by 8%. So if I'm buying a deal and it's cash flowing and it's doing very, very well at 7%, well, when interest rates do go down to 5%, I'm intrinsically going to have an 18% higher valuation on that property, because now somebody has that purchasing power. Because at 7% interest rates, borrowers only have so much purchasing power. When interest rates go down, borrowers have higher purchasing power. So if the deal pencils out now, then imagine it will pencil out when the interest rates do come back down, which we don't know.
Yeah, right. We don't.
Yeah.
So, the other question I have on that is, let's say a person's not looking to invest anymore. but they just want you to look at their portfolio. That's the thing, right? I mean, you can make an impact in that way.
Yeah, that's really more of it's more of a risk question.
Mm-hmm.
You know, I have people that say, hey, I'm going to have all my money in real estate. I don't want anything in the stock market, mm-hmm. right? And I have some people that say, hey, 50-30-20. This mm-hmm. guy uses a 50-30-20. He goes, I want 50% of my portfolio to be real estate that I control, mm-hmm. for clear. I want 30% of my portfolio to be the stock market. And I want 20% of my equity to be in other people's businesses and ventures and things like that. So people's risk tolerance on that is going to look a little bit different based on age, their demands. Somebody that's closer to retirement that really only has money in the stock market, they're going to need something that's going to increase and have more cash flow. Mm-hmm. If you're getting towards retirement age and you got $500,000 in the stock market, typically you're going to get a 4% safe withdrawal rate of return. So if you multiply 4% by $500K, you're only getting $20,000 a year in income.
It ain't enough.
That $500,000, if you can, let's say you can achieve 15% cash on cash in your rentals, now you go from a $20,000 income stream to a $75,000 a year income stream just by getting your money out of the market and moved it into real estate. Mm-hmm. So for clients that are getting closer to retirement age, that normally is the best solution. Is how can we get your money out of the stock market and into real estate where you can get higher cash on cash returns?
Fantastic.
Yeah.
Well, Ryan, is there anything else you want to add, Ryan? Anything else that you want to say about just, people getting involved with you? And if not, we can,
Yeah, I mean, definitely check out the content. Like I said, I spend tens of thousands of dollars a year, probably $100,000 in the last year and a half to build the brand and put the podcast and put the informational material out there for free for everybody. Mm-hmm. So please take advantage of it. And if you have any questions, again, like you said, you can follow up with me. Just learn like a CPA on all platforms too.
Great.
Yeah.
Ryan, thanks a lot for your time.
Thank you.
We appreciate it. Take care. People Not Titles signing off. Hey, thanks for listening to the People Not Titles podcast. We are proudly sponsored by Land Trust Title Services. If you enjoyed the podcast, please hit the like button. Please subscribe. And we'd love it if you'd share our podcast with your friends. Thanks a lot.